Hi, welcome to Ventura. In the next few minutes, we're going to tell you what a short strangle is and when you should try to employ it. Then we'll tell you what it exactly involves, what you can expect to gain or lose if the stock moves as per or against your expectations, and finally, we'll run you through a practical numerical example to illustrate the concept. We'll also quickly review it right after that. A short strangle is like a short straddle. It involves going short or selling options. It involves selling a call option and a put option at different strike prices, but in the same expiration period. Now, when should you employ a short strangle? The most essential condition for this strategy to deliver gains is that the market must remain range bound. That is, more or less steady. It is ideal for a market in which volatility is low and stocks and indices are not moving much. Here's what you need to do to create a short strangle. You sell a put option on a particular stock or index at a strike price that is out of money, and simultaneously, you sell a call option that is out of the money as well. You make sure that both these options have the same maturity date. Your incentive to undertake a short strangle is a premium you earn from both the call and put sells. Since you expect the underlying to remain relatively steady, you expect that you will be able to retain the premium income that arises out of it. You're, however, aware that in case the market does not move substantially, you could lose more than the premiums that you've earned. In fact, your loss will totally depend on the extent the market moves. Now let's see what your potential payoff could be. In a short strangle, your returns are limited to the premiums that you receive. Your risk, however, is unlimited. It is determined by the extent to which the price of the underlying is different from the strike prices at which you have sold the options. The further away the maturity price from the strikes, either above or below, the greater will be your loss. Here's an example to make this strategy really clear. Let's suppose the Nifty current month future is at 6,000 and you feel it will remain around that level at maturity. You could set up a short strangle by selling one call at a strike price of 6,200 and simultaneously selling a put at the strike price of 5,800. This strategy will earn you 100 rupees in the form of premium. And this is what your payoff graph will look like. If at maturity the price remains between 58 and 6,200, you keep the 100 rupees. That is your net premium, as both the options will expire worthless. If, however, the price rises or falls above 6,300 or below 5,700 respectively, you start making losses. Here's a look at the numbers behind the graph. As you can see here, we have two break-even points. The lower one is at 5,700 and the upper one is at 6,300. As you can see, between 5,800 and 6,200, your profit is fixed at 100, which is the highest profit that you can earn. Once the price goes below the lower break-even or above the higher break-even, you stand to lose to the extent the price goes beyond these. Now let's summarize our example. The cost of Strangle is 100 rupees, which is nothing but the net premium that we've received. The maximum loss is unlimited loss below the lower and above the upper break-even point. The maximum profit is the cost of the Strangle, which is the net premium that we receive, which is 100 rupees. The upper break-even point is calculated by adding the call strike to the cost of the Strangle, in this case, which makes it about 6,300. The lower break-even point is the put strike minus the cost of the Strangle, which is 5,700. While you may be clear about the reason for structuring a short strangle, which is basically the expectation that the stock or index will remain relatively steady, remember that it is time to exit this strategy when the market looks like it will become volatile or it crosses the trading range either on the upside or the downside. Let's quickly recap this strategy. A short strangle is a strategy that can be applied to a market, index, or stock.
that is expected to remain largely steady or range bound. It carries unlimited risk but limited possible returns. So, in a nutshell, it's a strategy for traders with a high risk profile. Thank you for viewing our presentation.